Hi, everybody. Welcome to our last Friday's Focus on Finances for 2021. My name is Jamie Fleming, and today I thought I would dedicate talking about financial New Year's resolutions you can keep and how to ring in the new year with better financial health. So it's important for everyone to reset their personal finances and their goals for the new year. So did you make any resolutions concerning your personal finances last January? If so, how did you do? Did you attain your goals or did you miss the mark a little bit? Or did you give up on your goals partway through the year? While the days leading up to New Year's Eve are often spent reflecting on the year gone by, the following days should be spent reflecting on the new year, reviewing your financial scorecard for the past year, and then looking for ways to simply improve. Remember, we talk about the little tweaks that make a big difference. The good news about New Year's resolutions is that you get a fresh crack at them each new year. So here are some financial changes that you should resolve to make in the year to come. The first, and I talk about this all the time, is calculate your net worth. If you haven't already done so, the new year is as good a time as any to determine what you're worth financially. Calculating your net worth is a key step in assessing your financial health and reaching your financial goals. The resolutions that you need to make will become more obvious after making this calculation. Looking closely at all your assets and liabilities helps to create a clear picture of where you're prioritizing your current spending and saving and where you need to make changes in those habits. It's a good idea to recalculate your net worth each year. Doing so can help you keep on top of your progress towards your financial goals and correct any mistakes or mishaps that you're making before they create overwhelming debts. When you do this, it'll allow you to make some changes like reset your retirement savings. If you have the opportunity to save for your retirement through a 401k, a 403b, or 457 plan sponsored by your employer, consider budgeting so you can contribute a set amount each month towards your retirement savings. Most people find it easier to max out their retirement contributions that way. So with your employer plans, if you have access to a 401k, a 403b, or 457 plan at work, then consider instructing your employer to withhold enough through salary deferrals to ensure that you reach the maximum limit each year. If you'll be age 50 or older by December 31st, then bump up that amount to account for the additional catch-up contributions that you're allowed to make. So if you're not 50, you can make up to $19,500 in 2021 to your 401k plan. And in 2022, that amount goes up to $20,500. If you turn 50, anytime before December 31st, you can take advantage of what we call a catch-up contribution, which is an additional $6,500 in that year. So for 2021, that's a total of $26,000 that you can put towards your 401k plan. That doesn't include any potential employer match. And then in 2022, that number is $27,000. So if you're paid on some other frequency, such as weekly or biweekly, then simply divide the contribution limits by the number of your pay periods for the year to help you make the maximum contributions. Here's the other good thing, and this happened for a couple of newer clients that started in the fourth quarter. They hadn't been fully taking advantage of the 401k plan. The good news is that they were able to talk with their employer, and for the last 2 to 4 pay periods of the year, increased their contribution. They had enough cash outside in their personal accounts to cover the higher contribution amounts. But for one of my clients, they put the total $27,000 in all in December for 2021. So it's still not too late potentially, depending on how you're paid and what the flexibility for your employer is. Regardless, if you're not maxing out your retirement plan, then make it a point that you start looking at January's pay period to increase your contributions. And budgetary wise, if you can't afford to put in the full amount, either $20,500 if you're under age 50 or $27,000 if you're 50 or older, put increase your percentage by a little bit. And then every quarter, take a look and see, how did that feel, instead of doing it all at once. So make sure it's within your budget to do what you're doing so that you're not getting into credit card debt. So then, are you self-employed? Let's say you're not an employee, a W-2 employee, and you're self-employed. If so, then depending on your income, you can contribute to a SEP individual retirement account, also known as a SEP IRA, a profit sharing plan, which would be a solo defined benefit plan, or a solo 401k plan. And if you'll be age 50 or older by December 31st, then the contribution limits jump for the solo 401k plans. And this can help you save even more, as we discussed prior with the W-2 employees. Difference is, when you're self-employed, you're the employee and the employer. So you get to take advantage of both sides of the equation. And in doing so, you're helping minimize your taxation, both on your side as an individual and the business side as an employer. And then we have what everyone has available to them are the IRAs. Even if you're covered under retirement plan at work, and you and your spouse, even if you're covered at work, you and your spouse can each contribute to a traditional IRA or a Roth IRA, as long as your combined taxable wages and net self-employment income are not less than the total amount contributed. Okay, so anyone age 50 or older can contribute an extra $1,000 for the catch-up provision, increasing the total allowable contribution to $7,000 or $583.33 per month. Keep in mind, however, that for 2021 tax year, a modified adjusted gross income of $125,000 to $140,000 for single filers. This actually raises in range next year to $129,000 to $144,000, and then $198,000 to $208,000 for married couples filing jointly, also rising to $204,000 to $214,000. This puts you in what's called the phase out range for being able to contribute to a Roth IRA. So if you're over that higher end for 2021 single filers, if you're over $140,000 for your adjusted gross income, you don't qualify to contribute to a Roth IRA. So keep that in mind. And for married couples for 2021, if you're over $208,000 of modified adjusted gross income, you don't qualify to contribute to a Roth IRA. There also may be limits on how much of your traditional IRA you're allowed to deduct. So there is something called a post-tax non-deductible traditional IRA, but you may want to look at other avenues rather than doing that. So you should only save amounts, as I said, that you can realistically afford, since contributing more than that may result in incurring debts to cover everyday expenses. So to determine how much you can save each period, incorporate your retirement savings into your regular budget. That's why I always tell people we look at your expense plan, right? Your expense plan also includes your savings for retirement and other financial goals. So with that, you want to update your goals. Creating easy access to your funds can be quite tempting, although there's the risk that if you're like most people, you'll spend money that you can get to easily. To help you reach your financial goals, be sure to transfer amounts earmarked for savings from your checking account to a designated separate savings or investment account, or better yet, have a set amount from your paycheck automatically deposited into savings. That will make it less tempting for you to spend the money that you have managed to set aside. This happens quite often. I see this a lot, where people will have all their money in one account for all their different goals, whether it's deferred expenses that they have, maybe pay once a year, or saving for a large ticket item. They have all the monies together, and oftentimes they'll be trying to use the same dollar for different goals and expenses. So if you can separate your emergency reserves into one account, separate deferred expenses, so expenses you know you'll have, like maybe your property taxes if you're not impounding, or if you pay your auto insurance once or twice a year, have a separate deferred spending plan so that doesn't get confused with savings, because you know at some point you're going to be spending that money. And then for your larger goals, have a separate account for those savings and investing. And that way you can clearly see how you're doing on each of those goals, and you're not tempted to spend the money for something that's in a different category. The next area that's really critical is make a plan to pay down debts. So take a few minutes now to set new savings goal for the new year, including how much would you like to add to your retirement nest egg, your children's education fund, or possibly the down payment on a home. You should also reset how much you plan to pay on your personal loans, debts, and even home mortgage accounts. Consider paying some extra principal towards your mortgage payment each month. By doing so, you'll earn a risk-free return on that money equal to the mortgage interest and cut down the number of years that it takes to pay off the mortgage. However, if you must choose between adding to your retirement nest egg and paying extra on your mortgage, you should talk to a financial advisor to determine which option is more suitable for you. With interest rates at all-time lows, you just might be better off investing the extra funds instead of paying down your mortgage. This is really critical, and where a financial planner or financial advisor can be really helpful in this area to do these different calculations. Oftentimes people put more money onto their mortgage, but then they have credit card debt, or they're not fully funding their retirement plans. This is detrimental in the long run because you won't have access to that extra money in your home. Where if you're doing both, you're paying your mortgage, maybe not early, but you have a very competitive interest rate, and you're funding your retirement plan, at the end of the day, you'll pay off your mortgage and however many years you have left, and you'll have your retirement savings as well. So you want to look at those numbers and determine what is the best to do. The other thing, and we've done this with so many of our clients, we have clients with the appreciation of real estate. We've had them refinance their mortgages because they were paying PMI insurance. They were paying mortgage insurance, right? Because they put down less than 20%. Now, because of market appreciation, they have over 20% in equity. We just help clients refinance. They'll pay off their mortgage in less time, actually, and they'll save $400 a month because of their lower base payment and not having mortgage insurance. That extra $400 can now be set aside for extra savings. That's $4,800 a year, $48,000 in 10 years. Over the life of the loan, almost $150,000 they saved by refinancing. So you want to look at all the different things. And that doesn't even include the monies that they'll earn by investing that $400 every month. That's just one of the ways we help our clients be more efficient with their money. The next thing you want to do, and even if you have just a 401k plan, you want to rebalance your portfolio. The previous year was no different from any other year. Some sectors overperformed and some sectors underperformed. Chances are that the sectors that did the best last year may not enjoy a repeat performance this year. So by rebalancing your portfolio to its original asset class or updated asset allocation, you take steps to lock in gains from the sectors that had the best returns. And with that appreciation, you purchase shares in the sectors that have lagged behind last year's leaders. This is an essential step to keeping your portfolio balanced and not too heavily invested in one sector when that sector has done particularly well. Many times, especially with my clients getting closer to retirement, with the last several years of our bull market, new clients coming in, what I noticed is that they were way overinvested in some of the large cap, mid cap, and small cap stocks. And so because that appreciated much more than their bond positions, their risk was way over what they would generally consider how they would feel for it. So if we have a major market correction, they might feel that more than they should because they didn't rebalance. Specifically, another area to look at is paying down your credit cards. If you owe on your credit cards, determine how much you can realistically afford to pay off during the year. And for the best results, try not to charge additional purchases on those cards while you're trying to pay down what you owe. If you have high interest rate card balances, consider whether it would be more beneficial to pay those higher interest debts or add to your savings. There are several debt elimination programs to consider, And you should consider a plan to do this so you're able to monitor your progress and make adjustments when necessary. The other thing to consider is assuring you're building an emergency reserves fund so that when something unforeseen comes up, you're not having to use your credit cards to take care of this issue. This often happens. People will say, I'm putting as much as I can to pay off my credit cards, but then they still have to use their credit cards because they're falling short in the month. So it's this hamster wheel of paying as much as they can, but without a spending plan to analyze, they're putting too much there. So they're not making as much progress, and they're constantly having to use the cards when they fall short. Another important area to look at every single year is review your credit report. Make sure that you check your credit report regularly and take steps to repair any negative aspects. Now, you're entitled to 3 free credit reports each year, so there's no excuse for not reviewing what is one of your most important financial reports, especially since errors in these reports are not uncommon. You don't want to find this out when you actually need the credit, when you're looking to buy a house or buy a car. It's easy to keep tabs on your credit report, whether that's getting 1 free copy a year from the 3 reporting agencies or reviewing your history through any number of free credit reporting sites. This could be one of the easiest ways for you to improve your financial health. A poor credit report could adversely affect the amount that you're able to save, as it could result in you paying higher interest rates on loans, thus reducing your disposable income. This is so critical. When you can save 1 or 2 or 3% interest on loans that you're taking out for larger ticket items, over the course of that loan, you will save sometimes thousands of dollars in interest if you can reduce your interest rate by 1, 2, or 3%. The next area is you want to review your life insurance and disability insurance needs. As you move through your career, your life insurance and disability insurance needs will continue to change. So give some thought as to how much protection you need and compare it to the coverages that you currently have through your employer's benefit package. Or if you're self-employed, review with different carriers to make sure that you have the most cost beneficial benefits that are available to you. Consider whether you need more or less life insurance and whether your needs would be better satisfied by either term insurance or permanent life insurance. Also review your disability insurance coverage to determine whether the amount you have is adequate. So a lot of people don't know if they have short or long-term disability coverage through their employer. One of the things we do with all of our clients is we look at their employer benefits so that they know how much they have, so we can determine what do they need to save in addition. So most plans for long-term disability will cover 2/3 of your current income. Now, if you're doing this through your employer plan and the premiums are pre-tax, a lot of times people like that, right? Because you're getting a tax benefit today. But keep in mind, if you're paying premium with pre-tax monies for disability insurance, then that 2/3, that 66% of your income is taxable. Now, for individuals who buy disability insurance on an individual basis, most of the time, those premiums are post-tax, right? They've already paid taxes on the premiums. But what that means for them is that if they need the disability insurance and they're getting that same 66% of their income, that's not a taxable benefit at that point. So you want to make sure not only do you know what your benefits are, but how they'll be taxed, because you may need to supplement if 66% of your income won't cover all of your monthly expenses. So make sure you're doing this every year, especially for my self-employed clients. If they got insurance, disability insurance 5 years ago, but their income has continued to increase, that original disability policy probably most likely only covers what they applied for at the time. So 2/3 of their income, maybe their income 5 years ago, and maybe they're making 2, 3, 4, 5 times more. So you can get additional supplemental policies. You don't have to give up the original because you probably got a good rate for that. So you want to look at, what do I need to do in addition to what you have already, especially if your circumstances have changed. So how do you maintain financial resolutions? The key for anything, it could be dietary, nutritional resolutions, it could be exercise resolutions. The key is to set realistic targets, right? And remind yourself why you made the resolution when you're tempted to give it up. Transferring money from your checking account to a designated separate savings or investment account that's not easily accessible, or having part of your paycheck automatically deposited into a savings account can also help remove those temptations when they come up. How much money can you put aside each month? So this depends on your individual circumstances, of course. Once you work out how much you have coming in and review your spending habits and debts, it should become clear how much you can reasonably set aside. When we're setting goals for our clients, it doesn't matter if our clients make $100,000 a year or $500,000 a year. We always get their spending plan, because we can't make recommendations that are easily attainable and maintainable if we don't know what they can afford to put away for savings. We're also looking at the best way to pay off any debts. People think, someone who's making 500,000, they probably don't have any debts. Interestingly enough, percentage-wise, they oftentimes have more debts and higher amounts of debt. Because the interesting thing is, the more money you make, if you don't have a concise plan in place that's being reviewed, then it's easy to have your money not working efficiently for you. So we develop these plans with our clients so we can make sure whatever we put in place is attainable and maintainable. And then we help our clients review this at least once a year to make sure we're updating for any goals that may have changed or new goals that come up. So some expenses, like a mortgage and utilities, don't allow for wiggle room, but there may be some room to cut down on other areas and allocate that money elsewhere. Generally speaking, financial experts recommend saving at least 20% of your income each month. My most successful clients and what I prescribe to is putting at least 25% or more away. So I use there's a lot of different variations of this, but I use what's called the 50-25-25 budget rule with my clients. The 50-25-25 budget rule is a simple template designed to help you reach your financial goals. So according to the rule this way, 50% of your income can be used or spent on essentials, right? So we have our mortgage and vehicle, as long as it's not, crazy expensive, but things that you have to have: food, shelter, clothing, right? 25% should be saved and invested, and the remaining 25% allocated to discretionary, non-essential purchases or wants. Now, initially, if 50% isn't enough to take care of debts that you may have, then that 25% allocated to non-essential items may need to be a little bit less in the short term to take care of all these areas, and then bump that back up. But that's your wiggle room area. That 25% for non-essentials is what you can look at even temporarily to get rid of things like credit card debts and such. So the bottom line is, take this opportunity to restate your financial resolutions simply and clearly for the new year. Be cautious about setting too many or unrealistic financial goals. Otherwise, you may be unable to accomplish any of them. And you can set out a schedule. If you have a lot of things that you want to achieve, put yourself on a schedule each month. January, I'm going to do these 3 things. February, I'm going to do these three things. Sometimes it's very overwhelming if you look at all the things that you have to do. But if you set it out into a schedule, then you can look at that each month and add to what you want to accomplish. It may be a good idea to maintain a checklist, like I said. That way you can keep track of how you're doing throughout the year so that you can make any necessary modifications. If you have a financial advisor, consider meeting with them to review the goals and objectives that you have established. And the thing is, when you do that, you have another set of eyes looking to see, where can we be more money effective, use our money effectively, like the refi that I talked about, saving those clients $400 a month. Now, mind you, they just purchased the house 2 years ago. So it's not like they had 15 years in and now we were adding a 30-year mortgage. We're actually helping them pay off their mortgage even earlier, got them a better interest rate, and opened up $400 a month for additional savings and investing. So you want to look at all the different areas, and over the next 30 years, it's going to make a significant difference in their financial picture. So here are some key takeaways. New Year's resolutions are often broken, but try to keep your financial ones, right? Give yourself a financial checkup to start the year. You got to look at reality so you know where you can make some adjustments. And paying down debt, contributing to your retirement plans, and making a budget, or what I like to call a spending plan that you can keep, can all help you ring in the new year with better financial health. So here are some final thoughts. Put your money to work. Managing your money effectively starts with careful planning. If you would like to see how these strategies can benefit you, take advantage of our complimentary consultation. Make that a New Year's resolution to have a complimentary consultation with a financial planner. If not me, somebody. Is having a financial planner and advisor to not only help guide you, but also keep you on track just might be the best gift you can give yourself for the holidays and into the new year. Thanks everybody for joining us today. The final Friday's Focus on Finance for 2021. Let's make 2022 a very prosperous and financially healthy year. Bye everybody.